Good day, my name is Papa. Today I am going to do with you financial reports and their purposes with particular focus on working capital reports. What are those working capital reports? Working capital reports, it refers to in the main three reports. One is a debtors report, two it's a stock report, three it's a creditors report. Why the three are called or are referred to as working capital reports? These are the reports which carry information about debtors, stock, creditors, of which the three are the areas in which in most cases cash of the business is tied in. For an example, in instances where we make sales in credit, those sales that are made in credit, we'll agree that they will have cash being held in them, in the sense that you will be expecting that people who owe you or who owes the business money will have to pay back that money in the form of cash. Secondly, stock. Stock as well, in terms of whether the stock is moving or stock is not moving, it also will have had cash being held on that. And in most cases, when we have got stock, either if you have got stock in cash or you have got stock in creditors, wherein you buy stock in creditors from your suppliers, you will also have in that situation the supplier cash that is being held in your hands as a business. As a result, you will have those three being considered as the most critical cash management, or what is referred as working capital, because that is the money that you will be needing for short-term purposes, like between a day and a month, or the cash that will be moving between a day and a month. Let's start with the debtors report. A debtors report is what other people refer to it as the debtors age analysis. Like we have alluded previously, that the debtors will be the amount of money that is being owed by people outside the company to the company. It's the money that's being owed by people outside the company to the company. So therefore, if you will have a debtors age analysis, it should be a report that shows all the other companies or individuals owing money to the company. So your report, very important, it should show you who owes the company the money. The second element that you will see in your debtors report is the amounts that these companies or individuals owe to the company. Very important with the amounts is the fact that those amounts ought to be accurate. As we've alluded again previously, that this is the cash of the company that's being held by people outside the company. You wouldn't want that situation being compromised by the fact that the amounts that are being owed to the company in some instances will be found to be inaccurate, or will be found its integrity to be questionable. So therefore it becomes again critical that that report should show you the amounts, exact amounts that are owed to the company. Thirdly, also critically important is the period when these amounts are owed. This is the period from which you will have to determine how long has the person or a company outside the business is owing money to the company. Has the person or the company been owed money for 1 day, for 2 days, for 30 days, for 60 days, for 90 days? You got to know how long a person is owing you money. Again, that's where it also becomes important for a business that as you deliver services or as you deliver products to your customers, you have got a clarity in terms of the period in which those services or goods have been delivered. The longer you take before you invoice your customer, the longer you should appreciate that your customer will pay you back your money as a business. So therefore it's very critical that your timing becomes critical. My advice is on the day, exactly on the day that a product is being delivered, you got to make sure that that invoicing is made on that day so that you don't have a disadvantage of period lapse in which a product has been delivered or a service has been rendered and there's a time lapse between that period that the service has been delivered or product has been delivered and the period in which that has been invoiced for to the customer. So very critical that your timing is properly managed, very critical that your timing is within a short space to make it a point that you're able to collect as quick as you should for purpose of better cash flow for the business. Let us look at the format of the data's report or the data's age analysis report. First, I want us to look at the names of the companies. You can see from this report, the report clearly stipulates the names of the people that owe your company money. You'll see in this case you have got Independent Corporation, you have got UNISA, you have got Unanism, you have got Human, you've got Tlala Trading, you've got Maketa Trading, you've got Matlasedi Trading, you've got Mbulelo Trading, you had Nagel's Export and Imports, you've got Plate Designs, you have got Patudi Mining, you have got Handicap International, and Riakotula SA. These, all of them, are the names of the companies, and the report all the time has to show the names of the companies that owe your company money. Secondly, your report has to show, or the data's age analysis report or the data's report has to show the amounts, that each company owes you. It has to show exactly how much those amounts are. And as I said previously, those amounts you got to make sure at all times that they are accurate, they are reliable, and they are not disputable. As you look at the amounts, what is the beauty of this report? In certain instances, it will show the amounts as negative. As you can see with Tlale Trading, for an example, it shows that they are on negative 8,500. A layman interpretation of this will suggest that your company owes Tlale Trading 8,500 because it's on negative. However, because this report, as I mentioned, it's meant for proactive management, it will trigger action from your side as an entrepreneur to say how come your business owes your customer money. That trigger could highlight a number of things which you could address timely. One, it could highlight that you have been paid money in advance. Having been paid money in advance, you didn't invoice for that money. That's why it shows the money at negative. If you don't address that, it could result to a number of things, which is one of those. You may end up giving refunds to customers which are unwarranted. you could give away money for free to customers because you're not following up on this. So it's important that you will see amounts either way. You got to see amounts exactly as they are, so that in certain instances like 8,500, like 1,200, like 13,200, like 51,818, those amounts, because they are negative, they will trigger action from your side to be able to investigate and come up with corrective actions. Thirdly, you need to have a report that shows you the time that you are being owed money. That time will reflect in the form of current, will reflect in the form of 1 to 30 days, 31 to 60, 61 to 90, and above 90. All these are your indicators of the time within which your business is being owed money. You don't always have to set up your time from 1 to 30, 31 to 60. Depending on the nature of your business, you can choose however you want to set up your time lapses. For example, for a business that has got cash, especially for business that deals with stock, and for business that has got limited or no credit facilities with the banks or funders, you will want to reduce this time. For example, instead of saying I've been owed money from 1 to 30 days, you can say I've been owed money to 15 days. That will be the decision of entrepreneur based on the nature of each business. However, you got to make sure that you have got all these indicators so that they can assist in you collecting the money. Secondly, with these indicators, when you set these indicators, it is important that your business set these indicators where a start date is the date that you have delivered the goods or you have provided a service. If you have provided a service and you want to invoice that service that's been provided or the goods that have been delivered at the end of the month, if you want to make the invoice at the end of the month, while you have got the goods or services delivered, for example, on the 15th, you got to make sure that you set up your system that it starts counting from the 15th than it starts counting from the 30th. I'll explain the reason for this. When you set it to count from the 30th, you will have a period of 15 days that you're losing your money because you have provided the service on the 15th, but you have delayed with another 15 days. That means in your case where you want to invoice at the end of the month while you have provided service in the middle of the month, you will be paid at the end of the next month. However, if you set it accurately, the timing of this aging, if you set it accurately, you will be paid 15 days earlier, meaning that you'll be paid the 15th of the next month instead of the end of the next month, which is the ideal situation that you will wish for your business. Let us now speak about stock report. A stock report in some instances will be referred as inventory report. A report that deals with the management of stock will have three features. One of the features will be cost of purchase to acquire that stock. That is the amount of money that you pay or the amount of money that you commit to paying for the acquisition of the stock should show as cost in your report. The second in your report, it should indicate the movement. You need to see when the stock moves into the business. You need to see when stock moves out of the business. In most instances, stock will move into the business when you purchase that stock from the outside into the business. And stock will move out of the business when you are selling that stock outside the business. Those two movements either way have to show into your report. Further to this, you also have to have an opportunity in your report to see the movements that are sometimes unexplainable. Your ideal, it will be stock moving out, that means it's a sale. Stock moving in, that means it's a purchase. But it's not always that as you see stock moving in and out, it refers to those two. So you'll also want to have an opportunity to see the movements as a result of unexplained actions in your business. Thirdly, your report has to show the amount of stock at hand. Amount of stock at hand, it means the stock that is available after the movement of whether it moves in or it moves out. You need to have that at all times so that you can be able to provide one with business continuity, meaning that you need to at all times know how much stock is left so that you can at an appropriate time buy to add on to the stock that is available. In that situation, you are able to provide continuity because stock is always available for your customers. Secondly, you need to have stock on hand so that it can provide you with an opportunity that from time to time you can verify. People say mobility of stock, it's almost the same as mobility of hard cash. It moves in an unbelievable speed in some instances. In that situation, because you have got this unbelievable movement, you want to from time to time do verification, which is called stock count. Let us look at the format of a typical stock report. First is the description of the stock. The description in instances where you have got multitude of stock items, you can describe them in codes. But in this instance, you can see the description is full as air conditioning. Secondly is the date. You need to have the date in your report. This date is a date that will show you when has there been movement on the stock. It will show you when stock came in, when stock went out. When stock goes out, it will go out for various reasons. One, which is an ideal situation, is when we sell it to people outside, like in this case. Secondly, it could be adjustments, it could be corrections that are made. The fourth item that should show is the quantity. You need to show the quantity. As the stock moves in and out, you need to show the quantity that is moving in or out. As the quantity moves in and out, you need to know how much is left, and that is called stock on hand. You need to show how much stock is left as you make those movements. Let's look at this for practical reasons. Description of stock in this case, it will be the air conditioners. Has there been movement on air conditioners? Yes, we can tell from the dates that there were movements. First movement you can see on the 17th of November 2020, there was movement of 1. Now, fact that that movement is negative, we can tell that is the amount of stock that moved out. That's why it's been put as negative. The reason why it's been moved out, you can see that there's a name of the customer. It means we have sold that stock to a customer. That's why it's moved out. The reflection of that moving out, it will show on stock in hand. You can see before the 17th of November, we had 38. You can see we had 38 air conditioners. Now there was movement of 1. We have got 37 air conditioners. This amount is critical because from time to time in the operation of your business, you'll be assured of business continuity because you know from time to time how much stock you have got left.
Secondly, should there be instances of unwarranted actions on your stock, for example, theft, for example, stock that gets missing, you can quickly tell from your stock balances. And thirdly, should there be a moment where you know you have to add on to your stock, you will rely on this amount. This amount will tell you if you've got 37, whether do you need to stock some more. It helps you to prevent a situation where you overstock or you understock. When you buy your stock or you purchase your stock on credit, it will result in you or your business owing third parties money for that stock. That money that's being owed to those third parties, it will reflect in what's called creditors report. Creditors report is one of those reports that other people call it creditors age analysis. What you see in that report, it is a direct opposite of a debtors report. One, three features that are the same is you will see the companies or individuals that your business owe money. The difference here is by the company. Previously, be reminded on debtors, it's those that owe your company. That is the companies or individuals that owe your company. In the case of creditors, it's individuals or companies that are owed money by your company. Second thing that will show it is the amounts. These are the amounts that the people that you buy stock from will show how much you owe those people money. Thirdly is the period. When did you buy the stock from those people? How long you owe in those people the money of the stock that you purchased to them. So it shows the same three features as your debtors report. However, the difference is the nature of interpretation. The one is what should come into the business, and the other is the what should go out of the business. Let's look at the format of a typical creditors report. The three features that I spoke about, the names of the companies that you owe money. You will see in this instance you owe Adonisite, you owe Cloud, you owe Combination, you owe IOD Africa, you owe Sage Roll, you owe Steel Pty Ltd, and University Solutions. These are the people that your company owes money to, and these people ought to show in your creditors report. Secondly, what you need to show in your creditors reports is the amount that those people are owed. Similar as in debtors report, those amounts you got to make sure they are accurate at all times. Can you imagine a situation where you are being overcharged? You can imagine what the effect will be in your cash at the bank. You will end up unnecessarily paying to your creditors more money. And that goes on for Cloud. It should show the amount that you owe Combination, so you can tell in all instances how much money you owe these individuals. However, I need to bring to your attention the signs before those amounts. In a case where your creditors report shows a negative, in this instance it says negative 500, it is a good trigger. It is a good trigger for your business because it would imply a number of things. One, it could imply you have paid as a business for goods before you take delivery. Not an advisable situation. At all times, at worst case, you pay as you receive. But for a fact that it's an indicator, it can trigger an action from you as an entrepreneur to want to know why are you showing it as negative, lest it happens that you have paid in advance or you have paid for stock that you have not received. Thirdly is the aging. Same as in debtors, is the aging that you owe people. That is the number of days that you have bought stock and you are owing for the stock. Where it's current, it means you just bought stock and you owe it at that moment. 1 to 30 days, that means you have bought stock between 1 and 30 days and you are owing your supplier the money for that period. Same as with 31 to 60 days, 61 to 90 days, and above 90 days. I'm sure some of you will remember I had said when you set up these dates in debtors, you got to make sure that the date of debtors is set on the day that you deliver the goods, because you want money quickly into your business. In the instances of suppliers, you work on the basis that the suppliers have provided you with an invoice or you have taken delivery of the goods from the suppliers. Why you need to do those two? You need to play a situation where you are able to hold on a little bit longer onto the cash that you paying your supplier without damaging the relationship with your supplier. With the cash coming in, you're making sure that you are able to collect a quick. Once the two variables play into a positive or play into a harmonious situation where you will be able to collect quick and pay later, that becomes good for your business in terms of the cash that is available for your business. So you can clearly see you've got the names, you've got the amounts, that you owe your suppliers, and you've got a period in which you owe these suppliers. And all these reports, the reports on debtors, the reports on creditors, the reports on stock, together, as you do your working capital analysis, they will give you the perfect answers. They will give you the areas that you have to intervene quickly to improve working capital, to improve cash in your business. For the fact that we're working on a notion that cash is king, you also have to keep it to yourself as an entrepreneur that these reports, you need to have them quicker than any other report. That is, for example, if you want to have your profit and loss report at the end of the month, you will be best advised to have this once in a week, because you don't want to wake up 15 days, 25 days or so later when damage is being done onto your cash.
With that, I wish to thank you for the time you spent in acquiring knowledge on how to use working capital reports for purpose of effective cash management of your business. At the same time, I wish to invite you to go through 10 questions to do a self-assessment on how have you gained the knowledge imparted. Thank you.